Welcome to the deep dive. Today, we're tackling PayPal's ticker PYPL, their Q3 2025 earnings release. It's dense stuff, as always.
It definitely is. And our job here is to take that source material and, well, make sense of it for you, our listener. We've broken it down into a 5-part framework.
Exactly. We want to help you get past just the headlines, understand what's really driving PayPal's performance, and connect that back to, market expectations and strategy.
So our mission today is pretty clear. Walk through these 5 slides we've put together. We'll pull out the key facts, maybe some surprising details, and definitely the strategic takeaways from PayPal's quarter.
All right, let's get started. Now for slide 1, the at-a-glance scorecard.
Okay, starting high level, this was pretty unambiguously a good quarter for them. A clear beat against what Wall Street was expecting, both top and bottom line.
Yeah, the revenue beat was solid. They reported $8.417 billion. The analysts were looking for, $8.26 billion, so comfortably ahead.
Right, about 7.3% growth year over year on that revenue line. Good, but not the main event here, I'd say.
No, because the profit numbers were where things got really interesting. Non-GAAP diluted EPS came in at $1.34. The street was expecting $1.19. That's a substantial beat.
A huge beat. And the growth rate on that EPS is really the story on this first slide.
It definitely got the market's attention. I mean, you saw the reaction. The beat, plus they raised guidance, we'll get to that later, shares jumped almost 10% in pre-market trading, up to $77.
That's a big move. And it feels justified when you dig into why that EPS number was so strong. Like you said, revenue grew 7.3%.
Okay.
But net income, that grew 23.6%. And GAAP diluted EPS, over 30% growth, 31.3% year over year.
That gap is massive, isn't it? How do you get earnings per share growing over 4 times faster than your actual sales?
It looks like financial wizardry, but it comes down to what you call the EPS multiplier effect, right? What drove it here?
Exactly. 2 big things. First, operational leverage. They're just getting more profitable on the operations side. That net income growth, 23.6%, being more than triple the revenue growth rate.
That tells you they're running the business more efficiently. Each dollar of new revenue is dropping more to the bottom line.
Okay, so efficiency gains are part 1, but that doesn't fully explain a 30% EPS jump. What's the second piece?
The second piece is all about capital allocation, specifically shrinking the denominator in that EPS calculation. The number of shares.
The buybacks.
Precisely. PayPal's average diluted share count dropped significantly. It went from 1,024 million shares last year down to 960 million this quarter. That's a reduction of over 6%.
And that wasn't accidental. They spent $1.5 billion buying back their own stock, about 21 million shares in Q3 alone.
Yep, a very direct way to boost EPS. So you combine that operational leverage with a shrinking share count, and boom, you get that 31.3% EPS growth.
It's a powerful combination. And just quickly, on those share counts, you mentioned diluted EPS. Why focus on that versus basic?
Good point. Diluted EPS, which used the 960 million share count this quarter, is the standard analysts use. It's more conservative because it includes potential shares from things like stock options.
Got it. Basic EPS just uses the common shares already out there, 950 million, so it would actually look even a bit higher, but diluted gives the fuller picture.
Exactly. It's the more comprehensive number.
Okay, so strong beat driven by efficiency and buybacks, but let's look closer at the quality of that profit. Moving to slide 2, the engine of profitability.
Right, because here's where things get a little confusing if you just glance at the numbers. There's a conflict in the margin trends.
Yeah, I saw this. The official GAAP operating margin actually expanded, went up 33 basis points from 17.7% to 18.1%. Looks like improvement.
But then you look at the non-GAAP operating margin, the one analysts usually track more closely for core performance, and that actually contracted slightly, down 19 basis points from 18.8% to 18.6%.
So which is it? Are core operations getting more profitable or less? This feels like one of those accounting quirks.
It absolutely is.
Yeah.
And in this case, we really need to lean on the non-GAAP number to understand the core operational trend. The GAAP number looks better mostly because of something that happened last year.
Okay, what was that?
In Q3 of 2024, PayPal had a pretty significant restructuring charge, about $35 million. That dragged down their GAAP operating income last year.
So the base was artificially low.
Exactly. This year, the restructuring charge was tiny, only $1 million. So the comparison on a GAAP basis makes 2025 look unusually good. Non-GAAP strips out those kinds of one-off charges.
So the non-GAAP view, showing that slight contraction, is probably the truer picture of the underlying operational profitability facing maybe some minor headwinds.
That's how I read it. It suggests some slight pressure on core costs relative to revenue.
Hmm.
And we can actually see confirmation of this if we look at another metric they provide, transaction margin.
Right, that's basically the profit they make purely on processing the payments after paying the networks and banks their cut.
Precisely. And that metric also saw a slight dip. It went from 46.6% last year down to 46.0% this year.
Okay, so it reinforces that non-GAAP story. A modest compression in profitability per transaction dollar. Not a huge deal, but something to watch.
Definitely. Keeps the focus on finding those efficiencies we talked about earlier.
All right, let's connect this to where the actual business growth is coming from. Next up is slide 3. The engine room business segment performance. Where's the real juice?
Well, that overall 7.3% revenue growth number we started with kind of hides the more interesting dynamics underneath. There's real diversification happening.
How so? Break down the revenue types for us.
Sure. Their core business,
Mhm.
transaction revenues, the fees they charge on payments that grew a solid 6.4%, that's still the bulk of their business, around $7.5 billion.
Okay, decent growth for the core, but what about the other stuff?
That's where the action is. What they call revenues from other value-added services. This includes things like partnerships, maybe subscription products, perhaps some merchant services. That segment grew almost 15%, 14.7% year over year.
Wow, okay. That's more than double the growth rate of the core transaction business. So that strategic push to build out other revenue streams seems to be working.
It really does. They're becoming less reliant purely on payment volume growth.
Yeah.
But the diversification isn't just by product type, it's also geographic.
Let's talk about the U.S. versus international. Where's the faster growth?
Big difference here. U.S. net revenues grew 5.2%. Solid, but, a mature market.
And international?
International net revenues grew 10.1%, nearly double the U.S. rate.
Okay, that's a key takeaway for you listening. It shows PayPal is successfully finding growth outside the U.S., tapping into markets where maybe digital payments are still gaining more traction. That's crucial for long-term growth.
Absolutely. It validates their focus on global expansion and suggests there's still plenty of runway internationally.
So the engine is diversifying both by what it sells and where it sells it. Let's look at the overall financial health and how they're rewarding shareholders. Let's review slide 4, financial strength and shareholder rewards.
Yeah, the balance sheet looks quite healthy. No major concerns here. They've got substantial liquidity, $14.4 billion in cash, cash equivalents, and investments sitting there as of September 30th.
And debt levels? Stable.
Pretty stable. The debt-to-equity ratio was 2.86, which is actually a slight improvement from the end of last year. So financially, they seem quite solid.
Okay, so they're generating cash, the business is growing, diversifying. Now, how are they using that financial strength? We talked about the buybacks already.
Right. The buybacks continued. Another $1.5 billion spent repurchasing shares in Q3. That was a primary driver of the EPS beat, as we discussed.
But there was something else, something new.
Indeed. The really big news on the capital allocation front this quarter was the initiation of their first ever dividend.
A dividend from PayPal. That feels like a landmark moment for a company like this.
It really does. The board approved a quarterly cash dividend of $0.14 per share. It's payable starting in December. They're targeting about a 10% payout ratio based on their non-GAAP net income.
What does initiating a dividend signal for a company that historically was all about reinvesting for growth?
It signals maturity, first and foremost, and immense confidence from management in the stability and predictability of their future free cash flow.
Meaning they believe they can keep funding growth and still have enough left over to return cash directly to shareholders on a regular basis.
Exactly. High-growth tech usually plows everything back in. Starting a dividend is a statement that says, we've reached a new phase. We generate consistent cash now.
And that fundamentally changes the investment thesis, doesn't it? It broadens their appeal beyond just growth investors. Now, income and value investors might start taking a closer look.
Absolutely. It's a formal acknowledgement of that shift towards becoming a more mature, balanced capital return story. It really caps off that narrative.
Okay, brings us to the final section. Finally, we have slide 5, the road ahead management's outlook and key takeaways. What's the view from the top?
Well, the tone from management is definitely optimistic, matching the numbers in the dividend news. CEO Alex Christ put it pretty directly in the release. PayPal delivered another strong quarter, and we are raising guidance. We have returned the company to growth.
Strong words. And they backed it up with concrete numbers, right? They actually raised their forecast for the full year.
They did. And it wasn't a token raise either. Full-year GAAP EPS guidance was lifted from a range of $4.90, $5.05, up to $5.11, $5.15.
Okay. And the non-GAAP guidance, similar bump. That went from $5.15, $5.30, up to a new range of $5.35, $5.39 for the full fiscal year 2025.
So management clearly sees this strong Q3 performance as sustainable, not just a one-quarter fluke. They expect the momentum to continue.
That's the signal, yes. Raising guidance, especially on EPS, shows confidence in both continued growth and that operational efficiency we talked about.
All right, so let's try to wrap this all up. If you had to boil down this whole quarter into, say, 3 key takeaways for someone listening, what would they be?
Okay, 3 things. First, that big earnings beat. It was significantly amplified. Yes, the business performed well, but the size of the beat owes a lot to that operational leverage kicking in. And importantly, that aggressive $1.5 billion share buyback reducing the share count.
Got it. Beat amplified by efficiency and buybacks. What's number 2?
Second, the sustainable growth story here really relies on their diversification strategy. It's working. Growth is being driven increasingly by international markets, which are growing much faster than the U.S., and by those other value-added services, which are outpacing the core transaction business. Right. Diversification in geography and product is key. And the third takeaway.
The third one has to be the dividend initiation. It's more than just giving cash back. It's the capstone event confirming PayPal's transition. They're signaling they've moved into a more mature phase, focused on balancing continued growth with consistent, predictable shareholder returns. It's a profile shift.
That's a great summary. Efficiency plus buybacks drove the beat, diversification fuels the future growth, and the dividend signals maturity. Makes sense.
Yep, that's the narrative of the quarter in a nutshell.
So here's a final thought to leave you with, listener, something to maybe chew on. We just saw PayPal, a tech giant known for growth, initiate a dividend. How might this move influence other large, perhaps aging tech companies? Companies that are also generating massive cash flows but may be facing slowing growth. Will we see more follow suit?
It's a fascinating question. And hopefully, using a structured framework like we did today helps you analyze those situations when they arise, cutting through the noise to see the underlying strategy.
Definitely. Now, before we sign off, the necessary reminders. This report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. Please always do your own research.
And just a note on how we put this together. This report was generated using an artificial intelligence model. While we strive for accuracy, all information should be independently verified.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.